Welcome to Phillip Futures Weekly Market Watch. My name is Lynette Tan and I'm an investment analyst with Phillip Futures. For the months of April to June this year, gold put up a lackluster performance amidst negative market sentiments and uncertainty on how the major global economies are performing. Spot gold traded near the key support level of $1,520 thrice in May, but was able to hold firm ever since, trading range-bound around the levels of $1,550 to $1,630 on central bank easing hopes and safe haven demands. We foresee that US remains subjected to elevated downside risks in light of financial strains in the euro area and uncertainty over domestic fiscal plans. The downside risks include the euro crisis and the fiscal cliff of expiring tax cuts and mandatory spending reductions that will take effect at the end of the year unless Congress acts. However, we see the potential contagion risk from a eurozone meltdown and the forthcoming fiscal episode as secondary to the threat of a sustained high unemployment rate. The US unemployment rate remains sticky at 8.2%. We therefore view the unemployment rate as a good indication of expansionary monetary policy, which will likely elevate gold price. A continually bullish factor for gold is the fact that the official sector continues to buy gold, thus lending support to gold prices. Official gold holding figures from the IMF confirm that central banks around the world continue to buy gold, some in pretty large quantities, testifying to the safety of the reserve asset. We think the trend is likely to continue, and more so in a big way, especially with the ongoing sovereign debt issues and its impact on the value of some key reserve currencies like the USD and the euro dollar. On the other hand, physical demand from India, traditionally the world's largest consumer of gold, is painting a bleak picture. The emerging country is suffering from a weakening rupee, which contributes to dismal demand in gold purchases. According to the World Gold Council, declining gold demand has already seeped in since last year, with a 19% year-on-year drop in jewelry demand and tumbling investment demand of 46%. With the weakening rupee and contagion risk emanating from the eurozone, we are not optimistic about a significant pickup in demand from India. The good news is that this waning demand in India could be replaced by a pickup in investment and jewelry demand from the growing appetite for gold in China. We expect physical demands going into third quarter to pick up slightly from India due to festive seasons in September, but headwinds from macroeconomics to continue to pull its weight if rupee continues to weaken in the months ahead. Given that gold has tested the key support level of $1,523 5 times in the last 1 year, it appears to us that any market which has been given multiple chances to trade lower but still holds its ground is signaling exhaustion of selling. Supported by encouraging fundamentals, we continue to be bullish on gold to continue its 13th year of bull run this year. The chart presented here shows the Fibonacci projections for gold prices for the rest of the year. In conclusion, for quarter 3, we expect gold to test the $1,750 levels that it has reached in February, with intensifying bearish sentiments surrounding economic growth to return gold to vogue. With this, I end the quarter 3 market outlook for gold. Stay tuned to the next weekly market watch.